Hey everyone, welcome back to the deep dive. Today we're going to be taking a deep dive into creative real estate investing strategies,
That's exciting.
especially for those of you maybe working with limited capital.
Mm.
Not all of us have a ton of money to throw around when we get started.
Right.
And we're going to be using Brandon Turner's The Book on Investing in Real Estate with No and Low Money Down as our guide.
Okay, fantastic book.
Really good book. And hopefully by the end of this deep dive, you'll have a better understanding of some of the financing techniques that are out there to help you get started.
Yeah, so you can actually make this happen instead of just dreaming about it.
Exactly. And you'll be surprised, I think, at some of the examples that Turner gives us of people who have made these low money down deals actually work.
Yeah, he really digs into the details. It's not just theory.
Yeah, and he gives like real world examples, which is what I always like to hear.
Absolutely.
But before we get into like the actual strategies, I want to talk about something that Turner emphasizes a lot, which is mindset.
Oh, yeah, that's crucial.
Yeah. So when it comes to investing with no money down, like what is the mindset that we need to have?
So he starts off by borrowing a concept from Rich Dad, Poor Dad,
Oh, yeah.
and that is asking the question, how can I afford it?
Okay.
And that really shapes your perspective. Instead of thinking, oh, I can't afford this, you're trying to find a way to make it happen.
Right, like a solution-oriented approach.
Exactly. It's about moving beyond those limitations and embracing possibilities.
I like that. So it's about shifting from like a scarcity mindset to like a possibility mindset.
Exactly.
Okay, so you're not just focusing on what you lack, you're focusing on what you could potentially achieve.
Exactly. And how to get the resources that you need.
Does Turner give us any personal stories to kind of illustrate how this works in real life?
He does. He actually started out with very little.
Okay.
He was practically broke,
Wow.
but he managed to build a really successful real estate portfolio by using creative financing.
That's inspiring.
Yeah. His journey is a testament to what you can achieve with a resourceful mindset.
So it's not about the money you start with, it's about the way you think about the problem.
Exactly.
Okay, so we've got the right mindset, but we also need some kind of guidelines, right? We can't just jump into this blindly.
You're absolutely right. Turner lays out what he calls the 4 rules of creative investing, and they're there to help you navigate this world strategically and responsibly.
Okay, I love a good set of rules. Lay them on me.
All right, so rule number 1, finding a good deal is absolutely crucial.
Okay.
And it's maybe even more important when you're using creative financing
Why is that?
because you're relying on other people's resources or unconventional methods, so the underlying investment needs to be solid.
Right, so you're not going to be able to, put lipstick on a pig with just a fancy financing strategy.
Exactly. A bad deal is a bad deal no matter how you slice it.
All right, what's rule number 2?
Be prepared to put in the work. Creative financing often requires more effort and flexibility than traditional methods.
So no get-rich-quick schemes here.
Definitely not. This is about rolling up your sleeves and being resourceful.
Okay, so it takes hustle.
It does.
What's rule number 3?
Creative investing is a marathon, not a sprint.
Okay.
It takes time and dedication to build wealth through real estate.
Patience is key.
Absolutely. And the 4th and final rule
Right.
is to have a financial cushion, even if you're using creative strategies.
That's good advice for anything in life, right?
Absolutely, because unexpected expenses come up, things happen, and you need to be able to handle those bumps in the road.
Right. So even though you're not putting a ton of your own money down, you still need to have some reserves
Exactly.
to make sure you can weather the storms.
Yeah, because things will happen.
So those rules really ground us and remind us that even though we're being creative, we still need to be responsible.
Absolutely.
So where do we start putting all this into action? What's the first step?
Turner suggests starting with owner-occupied investments.
Wait, so you mean buying a house to live in?
Exactly.
Yeah.
He sees that as a springboard to building a rental portfolio.
Okay, I'm not sure I follow that. How does buying your own home help you become a real estate investor?
Well, it's all about building equity. He uses a story of 2 college grads to illustrate this point.
Okay.
So they both buy homes, but one focuses on getting the absolute lowest down payment,
Okay.
while the other one prioritizes making low monthly payments and building equity faster.
Okay, so they have different approaches to their mortgages.
Exactly.
Interesting.
And even though they both eventually move out and rent their homes, the one who built equity faster ends up with a much better foundation for future investments.
Makes sense. So it's like even your first home can be an investment.
Exactly. You're setting yourself up for future success.
So even if you're just buying a place to live in, think about the long game.
Right. Think about how this property can help you reach your investment goals.
Really interesting. And Turner actually shares his own experience flipping a house with no money down right out of college.
Wow, that's impressive.
Yeah, so it's possible to generate profits and build that momentum early on.
Absolutely, and that early success can fuel your future investments.
Wow. Okay, I'm starting to see how that first property can be a stepping stone. But what if I'm ready to move beyond my own home and start investing in properties specifically for rentals?
Well, that's where government-backed loan programs can come in handy,
Okay.
specifically FHA loans.
Okay, I've heard of FHA loans. What's so special about them?
Well, they require a pretty low down payment, only 3.5%.
Okay.
And the cool part is you can use them for multi-unit properties.
So you could actually buy a duplex or triplex with a very small down payment.
Exactly. Imagine getting into a multifamily property with minimal upfront cash.
That's amazing. Okay, does Turner give any examples of people actually doing this?
He does. He tells the story of Lindsay, who used an FHA loan to buy a triplex.
Oh, wow.
She lives in one unit and rents out the other two.
Okay, so she's house hacking.
Yeah, she's generating cash flow right away and building equity at the same time.
Genius. Are there any catches with FHA loans?
Well, one thing to keep in mind is they do require mortgage insurance premium or MIP.
Ah, so there's an added cost.
Yes, it's an upfront and monthly fee that you'll need
Oh.
to factor into your calculations.
Okay, so you have to crunch the numbers and make sure it still makes sense.
Exactly.
Okay, I'm writing that down, MIP. What else?
Speaking of crunching numbers, what about rehabbing a property?
Yeah, that can be a big expense.
Like, especially if you're just starting out.
And you don't have a lot of cash on hand.
Exactly. But there's another FHA program that can help with that. It's called the 203K loan.
Okay, 203K, what's that all about?
It allows you to finance both the purchase price of the property and the rehab costs.
So you can kind of roll everything into one big mortgage.
Exactly. It's perfect for tackling those fixer-uppers.
So you don't need a separate construction loan.
Nope, it's all bundled together.
That's pretty cool. Does Turner give us any examples of how this has worked for people?
He does. He highlights the story of Eddie, who bought a really run-down duplex in Boston using a 203K loan.
Oh, wow. So he really got a fixer-upper.
Yeah, he put in the work, renovated the property, and ended up building a ton of equity in a short amount of time.
So it's not just about buying the property, it's about actively increasing its value.
Exactly.
Through smart renovations.
You got it.
I love these FHA programs. Are there any other government-backed programs worth exploring?
Well, Turner also mentions VA loans for veterans
Okay.
and USDA loans for rural property.
Oh, right.
These programs offer some unique benefits and flexible terms.
So it's worth looking into those if you qualify.
Definitely.
It's always good to know what's out there and see what aligns with your situation.
Absolutely.
Okay, but let's say I've explored all these government programs and I'm still coming up short on the cash.
Okay.
What other options do I have to make my real estate dreams happen?
That's where partnerships come into play.
Partnerships, okay.
They can be really powerful for unlocking opportunities.
So it's like finding a real estate buddy to team up with.
Exactly. Imagine someone like Bob, who has saved up some money, but doesn't have the experience or the time to manage properties.
Okay, I think a lot of people can relate to Bob.
Right. And that's where you come in with your skills and knowledge.
So it's about combining resources and expertise.
Exactly. It's a win-win for both parties.
What are some common partnership models that Turner talks about?
Well, he discusses three main types: equity partnerships, debt partnerships, and credit partnerships.
Okay, let's break those down. What's an equity partnership?
In an equity partnership, each partner contributes capital,
Okay.
and they share the ownership and the profits based on their contribution.
So it's like starting a business together.
Exactly. Turner uses the example of John and Cheryl, who partnered on a house flip.
Okay.
John provided the capital, Cheryl managed the project, and they split the profits.
So they each brought their strengths to the table.
Absolutely.
Okay, I like that. What about debt partnerships?
In a debt partnership, one person acts as a private lender, providing the capital, and the other partner manages the property and repays the loan with interest.
So it's like creating your own little bank.
Exactly. But with personalized terms and a direct connection to the investment.
Does Turner have an example of a debt partnership?
He does. He tells a story of Kevin, who got a private loan from a retired investor to buy a fourplex.
Oh, wow. So he leveraged someone else's capital to get a bigger property.
Exactly.
Okay, and lastly, credit partnerships.
Credit partnerships are all about leveraging someone else's good credit.
So you're borrowing their good credit score to get a loan.
In a way, yeah. It's often used with hard money lenders or private lenders who might be more flexible with their requirements.
Okay, so it's about finding someone with a strong credit history who's willing to partner with you.
Exactly.
Yeah.
But it's really important to structure these agreements carefully.
Right, you don't want to get into any messy situations.
Definitely not.
So you got to make sure everyone's on the same page and understands the risks. All right, so we've got these partnership models, but what does Turner say is crucial for finding the right partner and making these partnerships work?
He emphasizes two things.
Okay.
A strong elevator pitch.
Ooh, like a quick and compelling way to explain your business?
Exactly. You need to capture their attention and make them want to work with you.
Okay, so you got to be able to sell your vision.
Absolutely. And the second thing is a solid personal brand.
Okay, so your reputation in the real estate world?
Right. It's about building credibility, trust, and expertise.
So people know you're the real deal.
Exactly. And that applies to finding partners, securing financing, and building those long-term relationships.
So we've got partnerships, but what about leveraging something we might already have home equity?
Ah, yes. Home equity can be a gold mine for real estate investors.
Okay, but I always get confused between home equity loans and HELOCs. Can you explain the difference?
Sure. A home equity loan is a lump sum of money you borrow against your equity at a fixed interest rate.
So it's basically a second mortgage.
Exactly. A ELC, on the other hand, is a line of credit.
Okay.
It's more like a credit card that you can draw on as needed.
So you can borrow what you need when you need it.
Exactly. And it usually has a variable interest rate.
Okay, so one is fixed rate, one is variable.
You got it.
Does Turner give us any stories of people using these strategies effectively?
He does. He tells the story of Sean and Lynn, who used a HELO fee to buy a rental property outright.
Wow. So they were able to leverage the equity in their primary residence to get another income-producing property.
Exactly. Their primary residence was paid off, so they had a lot of equity to work with.
That's great. But what about people with less equity? Can they still use these tools?
Absolutely. Turner highlights Jessica's story. She only had a smaller amount of equity, but she combined it with a low down payment investment loan to buy a rental property.
Okay, so you don't need a ton of equity to get started.
Exactly.
But are there any downsides to using your home equity for investments?
There are a couple things to watch out for. One is over-leveraging. It's when you borrow too much against your home.
Okay.
And if the value of your property drops, you could end up owing more than it's worth.
Yeah, that's a scary thought.
Right. And the other thing is fluctuating interest rates, especially with HELOs.
Oh, right, because those have variable rates.
Exactly. So
Yeah.
your monthly payments can go up, which it can make it hard to budget.
So you really got to analyze those worst case scenarios and make sure you can handle the potential risk.
Absolutely. It's all about making informed decisions.
Okay, we've covered so much ground already, but I know there are even more creative financing strategies out there. What's next on our list?
Let's talk about hard money loans.
Ooh, hard money. I've heard that term thrown around, but I'm not really sure what it means.
So hard money loans are short-term loans with higher interest rates.
Okay, so they're not your typical mortgage.
No, they're usually used by house flippers who need quick access to capital.
So if you need to close a deal fast,
Exactly. They're not ideal for long-term investments because of those high interest rates.
so they're more for like quick flips. Okay, does Turner give us any examples of people using hard money successfully?
He does. He tells the story of Sam, a new investor who used hard money to buy and flip his first house.
So he was able to break into the market with limited cash.
Exactly. And Turner also shares his own experience using hard money.
Oh, really?
Yeah, both the good and the bad.
I'd like to hear about that in part 2 of our deep dive.
We'll definitely get into that.
All right, sounds good. I'm excited to keep exploring these strategies. Hard money sounds intense, but I'm starting to see how it can be a valuable tool if used correctly.
Absolutely. It's all about understanding the risks and rewards.
Stay tuned for part 2 of our deep dive into the book on investing in real estate with no and low money down.
We'll be back with even more creative financing strategies and inspiring success stories.
Welcome back to the deep dive. We left off talking about hard money loans, and I'm curious to hear about Turner's personal experience with them.
Oh yeah, he definitely has some stories to tell.
So what were some of the pros and cons that he encountered using hard money?
Well, he used it to flip a house. And while it allowed him to move quickly and close the deal, it also came with those high interest rates.
Right, that's the trade-off.
Yeah, and it ended up costing him more than he anticipated.
So it's not always the most cost-effective solution.
Exactly. And he also learned the importance of having a really solid exit strategy in place.
Makes sense. You got to be prepared to sell quickly when you're dealing with those high carrying costs.
Absolutely.
Okay, so hard money is a tool that can be powerful but also risky.
Right. You have to use it strategically.
So let's move on to another strategy that Turner discusses, which is private money.
Ah, private money.
What is it about private money that makes it so special?
Well, he calls it the holy grail of real estate investing.
The Holy Grail.
Oh.
That sounds pretty epic.
It is. It gives you a level of flexibility and control that you don't typically get with traditional financing.
Okay, I'm intrigued. Tell me more.
So basically, private money comes from individuals rather than banks or institutions.
So it's like getting a loan from your wealthy uncle?
Kind of, but it's more than that. There's a whole world of potential private lenders out there.
Really? Like who?
People who are looking for better returns than they can get from traditional investments.
Okay, so they're looking to make their money work harder for them.
Exactly. And real estate can be a very attractive option for them.
Okay, I'm starting to see the appeal, but where do you even find these private money lenders?
Well, Turner suggests a few different strategies. One is tapping into your own network.
So friends, family, colleagues?
Exactly. But he emphasizes the importance of being ethical and transparent.
Right, you don't want to ruin relationships.
Definitely not. It's about being upfront about the risks involved and making sure everyone's on the same page.
So communication is key.
Absolutely. What else? Networking events are a great way to meet potential investors.
Okay, I can see that.
And this is where that strong elevator pitch we talked about earlier comes in handy.
Right. You got to be able to articulate your business and its potential in a concise and compelling way.
Exactly. You want to pique their interest and make them want to learn more.
And, of course, online platforms like BiggerPockets.
Yes. BiggerPockets can be a gold mine for connecting with experienced investors.
I love that it's like expanding your network exponentially.
Exactly.
Any legal considerations we should keep in mind when dealing with private money?
Yes, definitely. Turner stresses the importance of compliance.
Okay.
It's crucial to understand the regulations surrounding private lending and to work with an attorney to structure the agreements properly.
Right, so no cutting corners when it comes to the legal stuff.
Exactly.
All right, I'm really starting to see the potential of private money. Does Turner give us any real-life examples of people who've made it work?
He does. One inspiring story is that of Duke Ong, who actually partnered with someone he met through BiggerPockets.
No way. That's amazing.
Yeah, they ended up investing in properties together across the country.
Wow, so they found their perfect real estate match online.
They did. And another great example is Glenn and Amber, who built a successful house flipping business almost entirely on private money.
Wow, that's incredible. So it's a strategy that can really scale.
Absolutely.
Okay, I'm adding private money to my list of strategies to explore.
It's definitely worth considering.
But now I want to talk about a strategy that I'm particularly curious about, lease options.
Ah, lease options, a classic creative financing technique.
Can you remind me how lease options work?
So basically, it's a lease agreement that gives the tenant the option to buy the property at a certain price within a specific time frame.
So it's like renting with the possibility of owning.
Exactly. It's a great way for tenant buyers to get into a home even if they're not quite ready to qualify for a mortgage.
Okay, I see the appeal. Does Turner have any real-life examples of this in action?
He does. He tells the story of John and Sally, who were able to get their dream home through a lease option, even though they couldn't get a traditional mortgage right away.
Wow, that's a great example of how lease options can help people achieve homeownership.
And Turner actually used a lease option himself to acquire a rental property.
Oh, really?
Yeah, he rented it out at a higher price than his lease payment, creating immediate cash flow.
So he was making money while he waited to exercise his option to buy.
Exactly.
Brilliant. Are there any other creative ways to use lease options?
Turner talks about a strategy called subletting.
Okay.
So you get a lease option on a property, then you sublet it to another tenant at a higher price.
So you're essentially becoming a middleman.
Right, and you're generating cash flow without actually owning the property.
That's really clever. Does he give an example of someone who did this successfully?
He does. He tells the story of Reginald, who made significant profits through what's called a sandwich lease option.
A sandwich lease option. That sounds interesting.
Yeah, it's a bit more advanced, but basically it involves getting a lease option from the owner and then subletting that lease option to another tenant buyer.
Okay, so there are layers to this sandwich.
There are, but it can be a really lucrative strategy.
So many possibilities with lease options.
Right. It's all about getting creative.
Any other words of wisdom from Turner about lease options?
Yeah, he emphasizes the importance of transparency and ethical behavior. You got to be upfront with everyone involved and make sure all parties understand the terms of the agreement.
So no shady deals.
Exactly.
Okay, let's move on to another strategy that caught my attention, seller financing.
Ah, Seller financing, the ultimate win-win.
What makes it so win-win?
Well, it allows the buyer to get financing directly from the seller,
Yeah.
bypassing traditional banks.
So you're cutting out the middleman.
Exactly. And this can be a great option for buyers who might not qualify for a conventional loan.
Okay, I see how that could be beneficial. Does Turner give us any success stories of people using seller financing?
He does. He highlights Josh Bowerl, who acquired 10 properties.
10 properties, wow.
Yeah, 13 units in total, all through seller financing.
That's amazing. How did he manage to do that?
He targeted motivated sellers who were open to alternative financing options.
Okay, so he was able to find sellers who are willing to work with him directly.
Exactly. And that's a key part of seller financing, is finding those sellers who are receptive to it.
Right, because not every seller is going to be okay with becoming the bank.
Definitely not. But there are ways to find those who are open to it.
Hey, like what?
Turner suggests looking for keywords in property listings, like owner financing or flexible terms.
Okay, so those are signals that the seller might be open to seller financing.
Exactly. And he also recommends using direct mail campaigns targeted at homeowners with a lot of equity.
Interesting. So you're reaching out directly to potential sellers.
Right. You're essentially presenting yourself as a solution to their real estate needs.
I like it. Any legal considerations we should be aware of with seller financing?
One thing Turner mentions is the due on sale clause.
Okay, what's that?
It's a clause that can be in some mortgages that requires the loan to be paid in full if the property is sold.
Oh, so that could be a problem?
It could be, yeah.
Yeah.
So you have to do your research and make sure the existing mortgage doesn't have this clause, or if it does agree, be transparent with the lender about your plans.
So transparency is key.
Always.
We've covered a lot of ground today, so many creative strategies.
I know there's a lot to take in.
But I'm feeling really inspired. I'm starting to see all the possibilities that are out there.
That's great. That's the whole point of this deep dive, is to open your mind to new ways of thinking about real estate investing.
Exactly. And I'm excited to keep exploring these strategies in part 3 of our deep dive.
Stay tuned. We've got even more to uncover.
Welcome back to the deep dive. We've explored a whole toolkit of creative real estate investing strategies, from FHA loans and partnerships to the ins and outs of seller financing and that exciting world of wholesaling. It's been quite the adventure. But there's one strategy we've touched on that I'm really eager to unpack: syndication. It feels like stepping onto the big stage of real estate investing.
You're right. It often does. Syndication is a powerful way to amplify your buying power and potentially tap into those passive income streams. It's like teamwork on a grand scale, bringing investors together to achieve what they might not be able to on their own.
So it's all about joining forces, creating a real estate dream team. But I'll be honest, the whole idea of syndication can feel a bit daunting. Where do we even start to unravel this strategy?
The key is to understand the roles of the main players, the general partners and the limited partners. The GPs, they're like the conductors of the orchestra. They're the experienced professionals who find and acquire the property, manage it, and ultimately oversee its sale or ongoing operations.
So the GPs are the ones calling the shots, steering the ship through those sometimes choppy real estate waters. And the LPs, what do they fit in?
The LPs are the investors. They're the ones providing the capital, the fuel that makes the whole operation run. They get to participate in these potentially more lucrative deals, but without those day-to-day management responsibilities.
Ah, the dream of passive income. It's what so many investors strive for, earning those returns without the constant demands of active management. But there are still risks for the LPs, right? They're relying on the expertise and decisions of the GPs.
Absolutely. No investment is completely risk-free. That's why it's crucial for LPs to do their homework and really vet those GPs they choose to partner with. Look at their track record, their communication style, and make sure your investment goals align.
It's like choosing the right captain for your ship, someone you trust to navigate those financial waters skillfully and lead the crew to success. But how do those GPs get rewarded for all their expertise and effort?
GPs typically get fees, a percentage of the profits from the investment. This motivates them to make decisions that benefit everyone involved.
A true win-win. LPs potentially earn passive income by participating in larger deals, while GPs get compensated for their expertise. But I think a question a lot of listeners might have is, can syndication really be done with no money down?
That's what's so fascinating. GPs usually don't contribute their own capital, so they acquire those multi-million-dollar properties using funds from LPs and securing financing.
That's incredible. Creating something from nothing? Turning other people's money into profitable investments? But I imagine it takes more than a winning smile and a big idea to attract those investors.
You're absolutely right. Building trust and credibility is crucial. Having a solid business plan, realistic financial projections, and a compelling investment thesis are all essential. But it goes beyond just numbers. You need to build relationships, be transparent about those risks, and communicate effectively throughout the entire process.
So it's not just about being competent, it's about connecting with those potential investors on a personal level. But what about the legal side of things? There must be some specific regulations governing syndications, right?
Definitely. Understanding and complying with SEC regulations is crucial. Turner explains two common types of offerings, 506B and 506C, which dictate how you raise capital and who you can raise it from.
Okay, let's break down these two paths. What sets them apart?
506B allows you to raise capital from both accredited and non-accredited investors, but it limits your ability to publicly advertise. You need those pre-existing relationships.
More targeted, network-focused approach. What about 506C?
506C allows broader marketing but limits participation to accredited investors.
Right, those accredited investors. A reminder for our listeners, what exactly makes an investor accredited?
They meet specific income and net worth requirements set by the SEC. This shows they have a certain level of financial sophistication and can handle the potential risks.
Okay, so 506B is about cultivating relationships, 506C, about broader marketing, but with stricter investor criteria. It's all about picking the right path for your goals. But the actual process of putting a syndication together still feels a bit mysterious.
Turner actually lays it all out with a hypothetical 506B syndication for a multifamily property. He walks us through each step, from creating that detailed business plan and securing financing to managing the property and eventually selling it for a profit.
It's like a behind-the-scenes look at a successful syndication in action.
Exactly. He breaks down the process, highlighting those key steps, potential roadblocks, and strategies for overcoming them.
This is making syndication feel much less intimidating, less like an exclusive club, and more accessible to everyday investors. But I think we need some real-world inspiration. Does Turner share any stories of those who've successfully used syndication?
He absolutely does. One that stands out is Ben Leibovich. He started small, investing in single-family homes, then gradually scaled up to larger multifamily properties through syndication. It's amazing to see that growth potential.
It's about setting ambitious goals, believing in your vision, and using collaboration to reach those goals. It shows that syndication isn't just for the wealthy. It can be learned and scaled over time.
You got it. And there are so many stories of people from all walks of life who've achieved financial freedom and built thriving businesses through syndication. It's a testament to the power of collective effort.
This entire deep dive has been incredible. We've explored so many creative real estate investing strategies, from those first steps to those giant leaps that can truly transform your financial future. It's been an amazing journey. But as we wrap up, what are some of the most important takeaways for our listeners to remember?
Well, if there's one overarching message I want you to take away, it's this. Creative financing isn't about shortcuts. It's about problem solving, being willing to learn, and building long-term success. It's about embracing challenges and setbacks as opportunities for growth.
So it's not just about making money. It's about that personal growth, the continuous learning, and the excitement of pursuing those real estate dreams.
Exactly. It's about building a business and a future you're passionate about.
This episode has been packed with valuable information. Mindset, goal setting, all those nitty-gritty details of specific strategies, from lease options and seller financing to wholesaling and syndication. A true masterclass in creative real estate investing.
And this is just the beginning.
Yeah.
There's always more to learn, more to explore, and more opportunities to create. I encourage you to go back, dive deeper into what resonates with you, and most importantly, take action.
This deep dive has been eye-opening. I'm feeling energized, ready to dive headfirst into the world of real estate, armed with all these amazing strategies.
I love that energy. And remember, it's not just about buying properties. It's about building that future you're excited about, that financial freedom, that lasting legacy.
What a fantastic way to wrap up our exploration of creative real estate investing. Thank you so much for sharing your expertise and insights.
It's been my pleasure. And listeners, remember, the real estate world is full of possibilities. And with that creative mindset, the willingness to learn, and the courage to take action, you can achieve incredible things.
That's a perfect note to end on. Thank you for joining us for this deep dive into the world of creative real estate investing. We hope you've discovered new strategies, gained valuable knowledge, and feel inspired to take your real estate journey to new heights. We'd love to continue this conversation, so connect with us on our social media platform and share your thoughts. Until next time, happy investing.